If you made it to this video, I first just want to say congratulations, because most people view online trading as a casino or a scam, or they don't know anything about it in the first place, and yet here you are interested in learning more about risk management. I can't make you any promises about whether this information will change your life, but what I can do is introduce you to a way of thinking about trades that will serve as the baseline for how you deal with risk moving forward. The tool you see here contains everything you need to create a trade. So there's going to be terms here that you need to know, such as total capital, position size, risk, leverage, stop loss, contract size, and fees. Your total capital is just going to be the total investment you are attempting to grow incrementally over time. Not all of your total capital is going to be on the exchange, since that would expose you to a number of risks, both external and self-inflicted, such as an exchange hack, losing account access, rogue wicks, or kamikaze trading. Next, you're going to decide what position size you're going to be working with as a percent of your total capital. Anything under 25% of your total capital is safe, but anything over 50% here is kamikaze. So don't get Thanos snapped and keep your position sizes responsibly small. You could up this number into the risky or dangerous levels just to be able to juice your other trade metrics a little bit better, because ultimately the more money you have on the table, the looser your stop losses can be and all that stuff. Next, let's talk about risk. Risk is probably the most important term on this list. And so what is risk? Risk is just the most amount of money that you are willing to lose in a single trade. It's not the same as position size because we're using a stop loss here. So ideally, you never risk more than 2% of your total capital in a single trade, and that's to protect yourself from loss streaks. Even if you were to up this up to just 5%, you're already at the kamikaze level, because if you had a small loss streak with this amount of risk, you would already be accumulating losses that you probably could not come back from. So make sure you keep your risk low. And another thing to mention about risk is that even if you're using a responsible percentage, make sure that the dollar amount is an amount that mentally you are okay with. You need to protect your mental health as a trader so that you can trade tomorrow. Next, we're going to talk about leverage. Leverage is just the factor by which you are borrowing money from the exchange in exchange for more buying power in the form of contracts. Two big things to remember with leverage are: one, that the higher the leverage, the closer your liquidation price becomes, and the tighter your stop losses have to be. And two, exchanges profit from market fees, which are calculated off of the total contract size, not your position size. Since your leverage allows the purchase of more contracts, higher leverage typically equates to paying proportionally higher fees. So if you're gonna borrow extra buying power, just know that it comes with a cost. Anything 5x or lower is usually pretty safe, but if you go 6 to 10, that's pretty risky. And if you go over 25x, that's definitely kamikaze, because your liquidation price is so incredibly close to you and the fees are so high that it's very difficult to actually make a profit. Stop losses are just orders that you place that will cancel out the original order if the price goes in the wrong direction. And this is going to allow you to control your risk, so you're not risking your entire position size in every trade. You're going to want to avoid placing stop losses too close or too far away from the current price action. Too close and you risk getting kicked out of the trade prematurely. Too far away and you almost certainly will not be maximizing other factors in your trade calculations. By changing the stop loss input here, you will automatically adjust your leverage and contract size. So if you are going onto the TradingView chart and doing your stop loss based on technical analysis, you may decide that you need a 1.17% stop loss. And so you click that in, and it'll tell you that you need to use a 4.27x leverage, and you need to purchase this many contracts. Final thing I want to talk about in this video is the fees. Do not trade on any exchange until you fully understand its fee structure, but there's multiple types of fees, and there's also rebates. If you do a market order, which is you basically fill someone else's order that they put on the books, you typically pay a fee. But if you're the one putting orders on the books that other people have to buy, then sometimes you'll get a rebate off these exchanges, and the rebate is often not as much as the fee, but it does help to reduce your net fees if you can limit order in or out of the position or both. But as long as you do it in one side of the trade, you're going to reduce your fees drastically. If you're getting paid to enter or exit your trade, make sure that you denote it as a negative number. So when these two numbers tally up, you've got the correct net fee amount here. If you ever want to refamiliarize yourself with these terms, you can check the definitions down below. In conclusion, guys, let me leave you with a powerful quote. Albert Einstein once said, "Strive not to be a success, but rather to be of value." And so when you're looking at these trades, do not try to win the world record for the biggest trade. Do not try to be the best trader. All you are doing is generating value. Are you able to generate consistent value on a day-to-day basis? Can you grow 1% each day? Are the little trials and tribulations and challenges just stepping stones leading you to your goals?